back to Box. In this video, I'm going to talk about the yen carry trade. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. I'll try and keep this video short. If you're new to the concept of the yen carry trade, what you're basically doing in this trade is you're borrowing a low yielding currency, such as the yen. And the way you can visualize that is by simply taking a look at the Japanese interest rate, which is set currently at 0.5% off of the lows at negative 0.1%. So you're borrowing this low yielding currency and you're using that borrowed currency to purchase a higher yielding currency, such as the US dollar in this case. And the way you can look at it is simply by looking at the US interest rate currently at 4.5%. Now, the reason why this trade is profitable is, you're pocketing the spread between the two. If your borrowing costs, and this is just, really a simple oversimplification. But again, if you're borrowing at 0.5% and you're receiving a yield of 4.5%, you're just pocketing that extra 4% spread. And hooray, you're making money. You're a genius. On top of that, if you also have, again, the interest rates playing in, which you do in currency pair, you also have a depreciation of the original borrowed currency. So you'll also have, again, the dollar strengthening against the yen in this case, which will also act as a tailwind for your trade. It'll be extra return on the trade. Now, for the purpose of this video, I'm going to look at interest rate differentials as the main source, the main dynamic affecting the currency pair. And this week we really didn't have much on the US side. We really had Japanese data come out this week. Last night we had inflation come out, I think something like 3.7%. Coming in higher than the forecast, which was at 3.5% for the headline inflation rate. Okay, let me see if I can grab this right here. Yes, here it is. Okay, this still has to be updated. Let's see if by switching on a monthly. Yeah, here we go. 3.7, and the forecast was for 3.5, so it actually came in a little bit hotter. For the moment, the first reaction has been not what you'd expect, meaning you'd expect the yen to strengthen against the dollar. In any case, this really is to show what is at play when it comes down to the yen carry trade. You have two sides of the equation. Okay, you have the US, and what you have at play in the US is the potential of a slowdown. Now, why is this significant? Because again, if you go back and look at interest rates in the US, which are currently at 4.5, again, this is what the Fed policy rate is being set at. But again, if you do have a slowdown, chances are you'll see interest rates start to fall in response to lower growth. Now, what does that mean in essence? Well, to keep things short, if you have convergence between US and Japanese interest rates, that will cause the yen to strengthen, okay? And that is kind of what we've seen, okay? The better way to see this, to visualize this, is between the 10-year in the US and the 10-year in Japan. What has been moving a lot of this yen strength is in the fact that we've had, ever since last fall, a significant rally in yields in Japan across the curve, really. At the same time, after we reached the top in 2025, we've had yields come down in the US and Japanese yields move up in Japan. And sure enough, right around here in January, that is when you've started to see significant yen strength. Okay, So what you really have to pay attention to when it comes down to the yen carry trade is potential for a slower US economy and inflation being hotter in Japan, because either factors will cause spreads between the US 10-year and the Japanese 10-year, the JGB, to narrow. And again, let's see if I can bring it up here. I already have it. Okay, so what you're seeing here is in essence visualization of the spread between the US 10-year and the Japanese 10-year yield. If you have next week, for example, PMI is coming in weaker than expected, and data continue to signal a potential slowdown, that will cause the 10-year yield to drop, and it will narrow. The spread between the 10-year in Japan and the US will narrow, and that will be a tailwind for Japanese for yen strength, really. So really, this is more of an update. This video here, again, what to look for. I think that we just got Japanese inflation, which will continue to keep the expectations for Japanese rates to go up, potentially at least. And on the US side of things, again, so next week we do have an important week. We have the S&P PMIs coming out, and what you're really looking for next week is a confirmation or really dismissal of what we saw in the last PMI report, where you basically saw optimism completely fade. And if we were to see better than expected PMIs, you could see yen weakness. If you see PMIs coming in weaker, you could expect yen strength. And the bottom line, why is this relevant to the to markets in general? Simply because as the yen strengthens, the investor that has borrowed yen has to give back more yen. Okay, you no longer have the depreciation of the original currency, and so you end up having to give back more. Okay, depending on what time frame you borrowed. But in any case, what people do when they borrow yen, they go and buy assets in the US, and if they get margin called on their original yen borrowings, they potentially have to sell all of the assets that they bought originally. So think stocks, think credit, for example. And so I put the yen carry trade as really the third on out of tariffs, government layoffs, and somewhat fiscal tightening or consolidation, however you prefer. I really put a third on the scale. I think that as long as tariffs and fiscal tightening are at play, I think those are really the two main events really that are defining this first quarter, and that will potentially be the defining events of really the first half of the year. And we also have tariff announcements on the 2nd of April, and that'll be worthwhile looking at as well. So really, when it comes down to the yen carry trade, you really have to think about it as two parts of the equation. Okay, on one side you have the US and the prospect of lower growth, and with lower growth come lower yields. Okay. On the Japanese side of the equation, you have hotter inflation, and with hotter inflation, you have rising yields. As the spread between the two, like the 10-year in the US and the 10-year in Japan, narrows, that will be a reason for the yen to strengthen against the US. And if the yen strengthens against US, there is a a pretty nice correlation with, like the risk off asset, which is the 30-year yield. Okay, you can really see this, like especially like even in recent history, ever since the beginning of March, you saw a bounce in the yen, and in purple you can see the 30-year yield having a small bounce as well. But in general, wherever the yen goes, the 30-year yield seems to go as well. So if you're interested in bonds, for example, again, keep an eye out for the yen. Okay, so look at potential confirmation of a slowdown in the U.S. and look for inflation data in Japan, as they can both be both can really be reasons for yen strength again. And again, the yen carry trade has really been talked about by a lot of people, and probably the fact that I've talked about it now in a couple of my videos probably tells you how overblown potentially it's become. But who knows? Maybe not enough people are talking about it. Time will tell on that. I'll leave it at that. If you like this kind of content, consider leaving a like. And if, again, really, consider leaving a like. And I'll see you next time. Bye.